The financial markets are indeed starting to price in a Trump victory. Not just that, though, but possibly a Republican sweep. I want to bring in 42 Macro founders and CEO Darius Dale. Let's talk about that because you've kind of written about that, but you also written about that with the fourth turning, right?
Oh, yeah.
And it's very intriguing stuff. Tell us first and foremost what the fourth turning is.
Absolutely. Well, thanks for having me again, Charles. Appreciate you, man. So the fourth turning is complicated, but I'll summarize it. It is a situation whereby you're likely to see a significant, for lack of a better word, all poop breaking loose politically here in the United States. Now, there's going to be a huge wave of populism in the beginning of that, and then at the end of that, there's going to be a big mobilization of public sector resources. Both of those are going to cause explosive growth.
To quell the...
It will crescendo. It'll all move in the same direction. Right. Both of those are going to cause explosive growth in public debt well beyond current projections.
Right.
And the only institution in the world that has a balance sheet big enough to finance this is the Federal Reserve, and they're going to do it.
Okay, so talking about that, then, some of the areas that you talk are really important. Income inequality.
Oh, yeah.
This is one of the big drivers
about
of this,
that.
right?
Yeah. Oh, yeah, absolutely. Well, fortuitously, one of the things that gets broken down in a fourth turning is income inequality as a function of the redistribution of wealth via populism, and we're going to continue to see that.
All right. From the financial markets point of view, asset markets perform in monetary debasement and financial repression. So, I mean, is it going to be the outcome is something that we want or we don't want? Is this a revolution that we want to happen? And I guess the Fed will be the cavalry, for lack of a better...
Charles, it's an outcome that we don't have a choice. And so what I'm trying to do as an investor is educate the world about these dynamics so that they can take advantage of it properly in their portfolios. We are all frogs being boiled alive in a pot of monetary debasement and financial repression.
Right.
And like I said, the Fed is the only institution in the world that can finance the growth of the public sector balance sheet.
So how do you take advantage of this in your portfolio?
Well, you generally want to remain long risk assets. Stocks, credit, crypto, commodities, gold. You don't want to be long a boatload of treasury bonds. I very much share Jim Bianco's view, consistent with our fundamental research themes, that inflation is likely to remain sticky, growth's likely to remain fine. There's nothing to see here.
Right. All right, so let's talk about some of the current positions and what's driving this market now. The resilient U.S. economy.
Check.
We have three economic data points today that point to that. Here comes liquidity.
Oh, yeah.
And Jay wants a soft landing. It's hard to argue with these two, although we don't need, it feels like we need less liquidity today than we might have thought we needed a week ago.
Well, we're going to get it anyway, right? This is the Federal Reserve cutting the policy rate with inflation on a supercore basis, 200 basis points above their target. They obviously have an asymmetrically dovish reaction function, which is what we've been arguing since the beginning of November of last year. You couple that with our resilient U.S. economy theme, which is where we've been since September of 2022. Right. I don't see how you don't have significant upside in asset markets.
All right, so we've got 30 seconds to talk left, but these are the sectors that you prefer in this environment. As we go from this environment into the fourth turning, these are the sectors you want to be in.
Well, these are the sectors I want to be in for the current Goldilocks market regime.
For the Goldilocks, okay.
Absolutely. We do see elevated risk of a positioning-related correction in the coming weeks, but that means we should be buying that dip in the context of these sectors, in the context of high beta assets as a function of, again, the Goldilocks market regime.
So the high beta is, for folks out there to understand that these are a little bit more volatile.
You want to take risk and make money. This is a time to take risk and make money.
But people should understand that the volatility may increase, but just buckle up and don't bail out.
I have a different view on that. I think it's best to sell at the top and buy at the bottom. But
who always knows the top and bottom? Everyone knows it after the fact.
Charles, the market will tell you. Right. That's the whole point. Follow the market. Listen to the market. It'll tell you if it's the top or the bottom.
So financials, technology, consumer discretionary, and materials.
Yep, this is Goldilocks here. We've been in Goldilocks, and we expect it to persist over the medium term.
All right. Thanks a lot.
Cheers.
Great work, Darius.